In this video, we're going to be talking about the importance of delayed gratification in your capital raising. If you like the video, like, share, and subscribe for more content just like this. So there's nothing like the cold, hard truth about raising money. You know, as founders, we're impatient, we're optimistic, we talk about our vision, we talk about our dreams with confidence, etc. Right? But when you start having conversations with investors for money, you know, it really starts to give you a different perspective. You know, from our perspective, what we're doing is amazing, right? Our business, our project, our idea, everything is amazing from our perspective. And we only see upside. That's what drives us internally, right? And we're, of course, our biggest fans. No one's invested the amount of time, the amount of energy, the amount of passion into building our project like we have. As soon as you go into capital raising mode, then you start to experience the rejection, right? Day in and day out. You start to discover that, you know what, maybe there is some flaws in your business. You start to feel like, hang on a second. You start to hear investors thinking that maybe your business isn't the rocket ship that you thought it was. Maybe I'm not the 10x to 100 times opportunity that they're seeking, right? And you also start to hear from investors all the things that can go wrong with your business as well. So that bulletproof mindset, and we've talked about this before, suddenly becomes a little bit fragile. We start to have some fear, we start to have some doubt, etc. 100% normal. The reality is what we all want is instant gratification. We want to put out our offer, we want to have money come in, we want to close it up, and we want to confirm that everything we're doing is absolutely amazing, right? Instead, what actually happens is the capital raising becomes a patient and diligent grind. And what's really interesting for most people to know, from my own perspective, I've had now 3 different investors become a shareholder around my business after knowing me for 7+ years. Right now, that thing's strange to you to say, well, geez, I don't have 7 years to wait to raise money. Relationships are powerful in the capital raising part. That like, know, trust, and respect are really important when it comes to having the money come across the line. Now, also do note that I have had situations where I've spoken to an investor once and they've become a shareholder, right? Now, the reality is that was from years of hard work, years of from being diligent, building the business, years of visibility, communication of strategy, communication of the vision, and also setting up a fairly investor-friendly process for them to go through, right? And that's obviously, you know, that's why we built CRIISP to do that. But all the work that I'd done for those years in advance made that process simple, right? Capital raising is going to be your humbling reminder that delayed gratification. It's the work you do today that's going to impact your business 6 months, 12 months from now, especially in the raising round. The visibility you create now, you're going to get benefit from it 6 to 12 months down the line. The conversations you're having today, the meeting that you're having, etc. You've all got to understand that the gratification will come down the line. It's absolutely an exercise in delayed gratification. My favorite example of this is Booktopia. You know, Booktopia, Tony's a fantastic guy. Love his energy, love his quirkiness, and love his passion. You know, Booktopia is the largest online retailer in Australia. They were participating in our Emergence event in 2019. They presented at both Brisbane, Sydney, and they also presented in Singapore. Now, the key meeting that come for them happened at nighttime, late at night, in the corner of one of the networking rooms, where they started having a conversation with an investor, which ultimately led to, I think it was like just under, it was about 10 months, 11 months down the track, becoming a $20 million investment. Patient, diligent, delayed gratification. That is what underlines the capital raising process. So the notes for yourself, the principles to take away from this is really simple. Now, 1, be diligent and persistent in your capital raise. That goes without saying, right? Understand, we've talked about the emotions of it. If you haven't, we do have a video talking about the emotions of going through a capital raising process. It is important that you actually understand those, be visible, and manufacture your own serendipity, right? That is what this journey is. As a founder, your job is to manufacture serendipity for your capital raise and just for your business in general, right? You've got to create those visibility opportunities to have those interactions. To be at the right time, at the right place, to meet the right person, and then to go on to make the right deal. Number three, investor feedback can be amazing in helping to refine your strategy. One thing that Tony highlighted was the key to the success of his transaction was the person that came on board with his business helped him communicate to investors in a way that they wanted to be communicated to. That was super important. That can make the difference. We see that often with founders. There's often a communication gap between founders and investors as far as the information that they're distributing and the way in which founders want, and the way in which investors want to receive that information, right? So that was an important note that I really learned from Tony. The next one is that there's always more people watching what you're doing than you may be aware, right? So this is about being persistent, because the question is how do you move yourself from being unknown to known? The other one is how do you move potential investors from sitting on the fence thinking, that's an interesting business, I like what they're doing, I like the progress they're making, etc., to registering interest to potentially invest into your business? How do you move them from that? Or the other one is, if they're already a registered interest, how do you move them from being a registered interest to actually investing into your business? The last one is our job is always the same, right? Said unknown to known, and then from sitting on the fence to potentially to being actively involved in your business. Then after, if they do become an investor, then how can they be an active participant, an active shareholder in your actual business? So hope that was helpful. As I said, like the video, please share it, subscribe to the channel. I said, we're always going to be putting out content like this. It really helps founders understand, I suppose, the nitty gritty and even just the high level principles related to raising money. Everything about this is helping you sort of lay a foundation for your success in the future.